Well, today, even more important than domestic cues are the global cues. So it's over to Nigel for the world view.
Well, on expected lines, the Fed went ahead yesterday and hiked interest rates by around 25 basis points to that range of around 2.25% to around 2.5% approximately. The U.S. markets, though, they ended in the red. They made fresh 2018 lows. In fact, some of those markets have moved to the lowest levels we've seen in the last 15 months or so. Well, a couple of factors that you all were pointing out as well. They've trimmed the 2019 rate hike guidance to around 2 from 3 earlier. So that's one point. You would have thought that was more dovish. But in fact, they went on to state that they'll continue shrinking the balance sheet and tightening the financial condition. So that didn't go down too well. They further went on to say, Jerome Powell said, that political considerations play no role whatsoever in its decisions, taking a bit of a jab at President Trump as well. In terms of the money markets, you saw initially the dollar index moved to around 96.9 odd, but the bond yields, they have moved to the lowest levels we have seen since May 2018 odd. So that was about the money markets, but plenty of losers, and they were selling across the board. You had Nike that was selling off yesterday. Apple as well was under some pressure. And a lot of those frontline large names did see some selling. Two stocks were in focus. One was Facebook. They admitted that they had given access of private messages of users to various big tech companies. So that stock was down 7%. And FedEx, that was lower. They're saying that, in fact, owing to those trade war concerns and political choices, that they have cut their guidance. So that stock was down close to around 12%. European markets, though, they ended in the green. They were waiting for Fed's decision. The Italian index, that was a big outperformer because the Italian government and the European Union, they came to a consensus. They've agreed that the deficit number will be at around 2.4%. Earlier, they were debating whether it should be at around 2.4%. Asian markets, all of them trading in the red. Remember, Brent crude prices continue holding below that $57 per barrel. But in that sort of a backdrop, the SGX Nifty is indicating a cut of around 90 points.
Okay, that's true. 90 points, but 90 points taken off after a 650-point gain over the last 10 days. So I guess some profit taking is on the cards. But what for the longer run? How should emerging markets read what the Fed has said? And what should an Indian investor worry about? Mark Mobius, founding partner of Mobius Capital Partners, and of course, almost the person who gave the word emerging markets in the mid-80s, is with us. Good morning, Mark. Thank you very much indeed for joining us. How would you parse the Fed statement as an emerging markets investor?
Good morning. It's good to be with you again. Yes, the Fed is going to continue with this disposal of all these assets that assets, I should say, that they've gathered over these few years. And so we can expect further rate hikes, but it'll be at a much slower pace, in my view, particularly since he used the word uncertainty, and since he said that there's a possibility of a slowdown in the U.S. economy. So that gives him the excuse to, slow down on this program that he's had. But I think the emerging markets generally have discounted most of that because, as you know, many of the emerging market currencies have come down dramatically, and of course with that the indices of the various markets have come down. We've seen a few recoveries, particularly in Brazil. It would be one good example, but generally speaking, I think a lot of it has been discounted.
Mark, like Chris Wood and many other analysts are pointing out, the Fed is not changing its quantitative easing wind-down program. Is that something to worry, or do you think emerging market currencies have already internalized that?
I think the emerging markets have generally internalized that. However, the uncertainty, the general uncertainty, gives people pause to pour too much money into emerging markets. We've seen some money coming in, but not to the extent that we would expect, given the very good growth outlook for emerging markets. But yes, the uncertainty is there, and therefore you're going to see a lot of people being very hesitant to put more money into the markets.
Mark, hi, good morning, and greetings of the season to you. The overarching theme seems to be the slowdown in growth, right? The Fed acknowledged that as well. Do you think that there is a fear of a recession in the U.S. markets at the start of the next year, or is that fear unwarranted for now?
Well, very much so. I believe that there is a fear because the stock market is giving us a message, of course. The S&P has slowed down, has corrected rather substantially, and that is a signal to people that maybe something is going to happen. As you know, the political situation in America is very uncertain, and you're going to have the uncertainty continue as the Trump investigations go forward. So this is also a reason to be very cautious.
Okay. Mark, let's come to India. In the past 10 days, since the BJP government lost 3 state elections and the results came on December 11th, since then we have put in about 600, 700 points on the Nifty. Do you think we have, we have risen too fast? I guess the response is to the fact that crude prices have now crashed to $56 for Brent, and the Indian Reserve Bank also is pumping in a lot of liquidity. Do you think we have run too fast? Would you buy even at current levels?
Oh, yes, we definitely would. India looks very, very cheap. And, of course, as you said, with the Brent down, this is very bullish for India. What is concerning to us is the political talk about the farmers' loan forgiveness,
yes,
which is palliative. Of course, it's very good for the farmers for the short term, but for the long term, it's not a very good move, I believe, because it means that you're not looking at the basic problems, which is infrastructure and other aspects which will help the farmers in the long run. And then, of course, the angel tax is very scary. So these are concerns, but they're relatively minor. When you look at the overall situation in India, it looks quite bullish in our view.
Okay, so you said that you would buy into India now. My next question to you is, do you think India would stand out and decouple from the developed market slowdown in 2019? Or could India be also dragged down by the global growth slowdown that we might see?
No, I believe that India could decouple and move forward in view of the incredible growth rate of the economy, one of the highest in the world. Of course, among the major countries, now India stands out. With China slowing down, India has a good chance to stand out.
What part of India do you like? Let me start with financials, since they are 40% of the big indexes. Which part of the financials do you like?
Well, I like the smaller banks, the non-bank financial institutions, and the medium and small-sized banks. There's some very interesting opportunities there. On a regional basis, you're seeing some interesting things happening. So that would be the place where we would look.
You did speak about how measures like the farm loan waiver, etc., may not be the best thing for India at the moment. But you know what? As we head into the elections, Mark, we may be hearing more of such populist measures. Would that deter you from putting fresh money to work, or would you use every dip to buy into India?
No, it wouldn't deter us, because in the short term it'll look very, very good. But it's a disappointing move from a longer-term perspective, because it means the politicians are not really focusing on some of the fundamental things. And particularly infrastructure in India needs a lot of work so that the farmers can get their produce to work. That sort of thing is more and more important. But in the short term, of course, the loan forgiveness helps the economy, and then you get a boost to growth.
Well, just a final question. Since you speak about the divergence between a short-term gain from these kind of giveaways and the long-term harm to credit culture, I just want to ask you about this huge liquidity boost that the Reserve Bank is giving. Some 2 trillion rupees of bonds it is going to buy from December to March. Obviously in a bid perhaps to assuage fears of the debt problems of the NBFCs. Do you think we'll live to regret this? Some time back when we did similar liquidity infusions, we harvested inflation about a couple of years down the line.
Of course, and that is the price to pay. Now, the only proviso is that if the economy picks up at a rapid pace, then the government will be able to gather taxes in order to pay for this debt.
Yes.
But otherwise, definitely, it's a real problem down the road for the government if they don't achieve that high growth rate.
So in just over 100 days from now, Mark, we may or may not have a new government here in India. Would that in any way make you change your investment call?
Definitely, there'd be a real problem if you see the reforms that Modi has introduced disposed of, that would be a real backward step. Now, I believe that the Congress Party would not do that. They probably continue, but populist measures are not a good medicine for the economy.
Yes, I guess you can't push back the goods and services tax. It's way too entrenched now and would be way too disruptive. Other than financials, what interests you? Is it consumption? We are seeing incipient capex excite stocks like L&T. Would that interest you?
What interests us is the consumer side, because with this loan forgiveness, of course, you're going to see consumption skyrocket, and you're going to see many, many opportunities in the consumer area. So I would say consumption is, with the increase in consumption, companies benefiting from that would, of course, be on our target.
So what's your top market to invest into in the year 2019?
India, actually, India's right at the top, which is why I'm here now.
Okay. Yep. Mark, that's a great note to end this conversation. Thank you very much for taking our call. I think that last sentence should be framed. You know, coming from Mark Mobius, it's not an ordinary statement. He has been there, done that for 30 years. The man who created the word emerging markets and spearheaded the entry of foreign investors into emerging markets first and then to India in particular. So when he says India is the top pick, makes you happy. And, you know, yesterday's FII numbers were 1,200 crores.
Yes, they were. So, but like he said, you know, so a few niggling worries, like perhaps some populist measures, etc., that may deter
that's
investors.
Really a worry, you know, when you look at this kind of liquidity infusion. It's obviously being done to ward the government from forcing the Reserve Bank to give a separate credit to NBFCs. To keep that demand at bay, the Reserve Bank is obliging with overall liquidity with which it is more comfortable. But I can distinctly remember, you know, the same medicine was administered in 2012 and then we harvested, you know, 2-3 years of double-digit inflation. Today, inflation is like, you know, people will laugh at you if you use that word. But are we taking too much advantage of this? Yes, it is very low. And yes, probably a rate cut is likely in the months to come. But let's be wary that in the past, this medicine has also brought its problems.
Okay, well, let's see which way the RBI goes, right? After what the Fed did, I mean, it doesn't look like there could be any softening of
in that case, just a word on the MPC minutes that was also released yesterday. They did indicate a lot of caution. You know, we don't have to worry so much about what Governor Urjit Patel said because he will not be a voting member in the next MPC. But if you looked at the statements coming from Michael Patra, from Aviral Acharya, from Chetan Ghate, they were steeped in caution about, you know, whether this kind of disinflation can continue and worries about core inflation. Late data that has come after that, after the December 5th policy, have been more benign. You know, core inflation has also dipped. So maybe they'll change their stance somewhat. But too many rate cuts is not what you can read from the minutes.
Yeah. I mean, logically also you wouldn't expect it when globally you're seeing rate hikes, right? I don't think the RBI would decide to cut anytime soon. But let's see which way things go. For now, let's take a quick break. Our list of top 10 stocks is lined up on the other side of the break. Stay with us.